Welcome, everyone, to today's Associates meeting at the Stanford Institute for Economic Policy Research. I'm Mark Duggan, the Trione Director of SIEPR, and we're in for a very interesting talk featuring Jonathan Levin, the co-founder of a company called Chainalysis. We've been busy recently here at SIEPR on the events front. For example, just 2 weeks ago, we hosted a major in-person 11-hour event focused on homelessness in California. And a few weeks before that, we heard from the chair of President Biden's Council of Economic Advisors, Cecilia Rouse. It's been terrific to see activity picking up on campus here at Stanford. And I'm also grateful that we're able to continue doing online events like this one to ensure that more people can be brought into our orbit pretty easily. While there's a huge amount of positive energy picking up, I know this has also been a very trying time for our country and the world as a whole, and for many of us personally. We've all, of course, been shaken by the recent spate of mass shootings. COVID infection rates have been on the rise, and I know that many of us have either been sick or know someone who has contracted COVID, and war is raging in Ukraine while inflation is straining everyone's wallet. So in light of the many problems that we're all facing here and around the world, SIEPR is more committed than ever to producing and disseminating research that can help improve decision-making in Congress, in boardrooms, and in state houses across the country, and really around the world, as officials grapple with really important and pressing economic policy questions. Much of our recent research has touched on several of these topics. We've produced policy briefs in the past few weeks on the long-term impacts that school shootings have on the students who survive them, policy moves that the Federal Reserve is making, and what we can do to better understand the root causes and consequences of homelessness in California and throughout the US. And today we have with us Jonathan Levin, who, among other issues related to cryptocurrency, we'll discuss global financial security and concerns about the use of crypto to dodge worldwide economic sanctions placed on Russia in light of the invasion of Ukraine. Jonathan is very well positioned to discuss these issues. As co-founder and chief strategy officer of Chainalysis, Jonathan helps government agencies, cryptocurrency businesses, and financial institutions investigate illicit activity, comply with regulations, and mitigate risk through anti-money laundering technology and education. Jonathan has testified before Congress and government agencies on the emerging risks and opportunities in cryptocurrencies. He's also a mentor for the Techstars Alchemist Blockchain accelerator and serves as the CEO of Coinometrics, which provided the first dashboard of blockchain intelligence. He researched cryptocurrencies as a postgraduate economist at the University of Oxford. And Jonathan also shared with me just last week that his email address at Oxford was the exact same email address that was assigned earlier to another Jonathan Levin, who is the Dean of Stanford's Graduate School of Business and is also one of our senior fellows here at SIEPR. And apparently that led to a few instances of mistaken identity because, of the same email. But I'm very honored to have this particular Jonathan Levin with us today at SIEPR. I think we're in for a very interesting conversation, and I invite all of you to submit questions through the links on your screens. We'll get to as many of them as we can before we have to wrap up at 6 p.m. Pacific sharp. The approximate game plan is that Jonathan will speak for the next 15 or 20 minutes. Then he and I will have a conversation for the next 20 minutes. And finally, I'll select questions from the audience for the last 20. However, lately I've been pulling questions from the audience sooner because just to mix things up a little bit. So please feel free to submit your questions just as soon as they pop to mind. And that is through the link on your screens. So thanks so much to every one of you for joining us today. And thank you for your support of and engagement with SIEPR. And with that, let me turn things over to Jonathan Levin. Jonathan, thanks so much for being with us.
Thanks, Mark. Pleasure to be here. It's been quite a while since I've done an economic seminar. So there's no equations on these slides, just for anyone who is worrying about that. Can you all see my screen okay?
Looks great.
Okay, great. So nice to meet everyone. Thanks for taking the time to learn a little bit more about cryptocurrencies. As I said, my name is Jonathan Levin. I've been in crypto now 10 years. And so the insights that I try and share today are really things that I've been thinking about for the past decade. And it took the best part of a decade to get to most of these realizations. And the first one that actually, may seem a little bit obvious on the surface, but I think is actually quite difficult for most people to grasp, is that cryptocurrency is not just a payment system. It's actually a technology. And when it comes to technologies, there's actually sort of an adoption curve that people think about when they see new technologies taking off. And it means that it's very difficult to predict the end adoption rate and end impact of a particular technology on a variety of different industries. And so many people think about cryptocurrencies as sort of these digital assets that are traded. I would posit to you that actually it's a much broader phenomena about the representation of value of all different forms, and is unlocking ways in which new markets get created, and that's very hard to see at the beginning phases of a technology cycle, where it seems impossible that that technology becomes ubiquitous, but ultimately is inevitable. And there's lots of examples of this, and I won't bore you with all of them. And I have to thank Carlota Perez about mapping the types of adoption curves like this. But you can see that of recent technologies, it was hard to predict that the internet would become as ubiquitous as it is today, that we'd be able to live stream video and slides all over the world instantaneously. And we thought that we would still be in lecture theaters and in Stanford at this point. But eventually, these adoption curves become very, very steep indeed, and their ubiquity becomes inevitable. And so, the very simple idea that I had when looking at this is that the internet, what the internet really did at the most basic level is made the distribution of information instant and universal, that anyone in the world could instantaneously send a message to anyone else in the world. And that gave rise to not just messaging, but full-blown, publishing platforms and, different market dynamics that we've never had before. And, the internet didn't have a good way to actually capture what value is. And there is no native way on the internet to represent value. And yet, we need a distributed way to actually represent value on the internet. And that's really where the technology behind cryptocurrencies come in. And I think that the way that I would think about this is that, there are just many weird things that happen on the internet that actually sort of people don't really understand or appreciate quite how massive these markets are. I mean, this is an artist called Beeple who auctioned off a 500 or 5,000 days of art that he had made. He makes one of these drawings every single day, and this is I think it's 5,000 days of work or something close to that. And that's something that is a representation of a value and a provenance of the artist giving something directly to a consumer, and then being able to share in the economics of how that artwork gets traded into the future as well. And those types of the unbundling of markets, where there is the ability for artists to potentially go directly to consumers and have these types of interactions, actually creates new opportunities inside the internet that we actually couldn't have before cryptocurrencies were created. And the other sort of interesting thing is that there are sort of payment use cases that start to pop up, and you get sort of institutions and organizations that you would sort of least expect to adopt cryptocurrencies to actually use, in this case, a USD denominated stablecoin to actually pay medical workers in Venezuela. And this is something where it's really the technology itself rather than the asset that gave rise to this use case, because actually it was very difficult for the US government to send money into Venezuela with the right level of visibility that made them comfortable to do so. But actually in cryptocurrencies, you can send, for example, a USDC transaction and see exactly where that transaction ends up and make sure that it's done for the right purpose, or you can actually freeze that afterwards. So this is really like what I would consider to be, cryptocurrencies, the technology, creating new markets, creating new possibilities with the technology that actually impact, a very large range of different industries. And so that for me is like the first sort of framing on cryptocurrencies that I think people often miss. And actually, I think today is actually becoming more and more prevalent, as the technology matures. The second thing that I think many more people maybe understand in this audience, as well as in sort of broader audiences, is that cryptocurrencies as an asset class. And I think that this was really born out of the financialization of Bitcoin and Ethereum. And what I mean by that is, you had the invention of these cryptocurrencies, which are native digital tokens that are bearer instruments that someone can hold themselves. That in and of itself is not necessarily an asset class. It becomes an asset class when, people are willing to lend against it, people are willing to borrow against it. There is actually, structured products and swaps and future contracts and, the types of financial instruments that we're used to seeing in other asset classes. And so I think what we have seen over the past decade really of cryptocurrencies is that it's matured from people speculating on individual tokens and individual currencies into something that's maybe a bit broader and should be considered an asset class rather than simply a digital token in and of itself. And when it comes to different asset classes, the creation of asset classes is not something new and happens actually fairly frequently in financial markets. And what we see there is that financial institutions tend to want to enter in to support all the different asset classes to effectively serve their customers. And so, I would say for the first decade of cryptocurrencies, from say 2009 to 2019 or 20, you had really sort of low value, in total, cryptocurrency market cap, which maybe isn't the best metric of total outstanding cryptocurrency, but is indicative of where the market is. And if you think about what's happened over the last sort of 2-3 years, again, sort of lending products taking off, yield products taking off, future contracts being listed at CME and CBOE, it really starts to resemble an asset class rather than just tokens being traded. And this is where you start to see the different business opportunities that financial institutions are starting to think about. Famously, Fidelity offering custody on Bitcoin and Ethereum to their clients. Bank of New York recently looking at cryptocurrencies and offering custody to their clients. PayPal today had another announcement that they allow their consumers to use PayPal as a wallet to be able to deposit and withdraw cryptocurrencies, as well as buy cryptocurrencies on their network. And so really you start to see really this dynamic of financial institutions, early adopters, becoming public with their Bitcoin and Ethereum offerings, particularly in the custody and brokerage space. And then, lots of people following from that. I think the other dynamic just to point out here is that really, financial institutions generally have been pretty preoccupied with and worried about disruption of their operations from fintech firms, and that seeing fintech firms really embrace cryptocurrencies made banks really consider whether cryptocurrencies was something that they also needed to be involved in. And so, yeah, we've seen a lot of different financial institutions enter the space, and they see that as a pretty significant business driver, not only for sort of the short run, but also the long run. I was also asked to sort of comment a little bit about what Chainalysis is, and I think that for me it starts with that vision that I just sort of laid out, which is cryptocurrency as a technology is and could be sort of as instrumental as the internet in terms of structuring new business models that we haven't really seen before happen on the internet, and that we have the maturity of an asset class that represents a full-blown financial ecosystem that financial institutions are embracing around the world. And then the question is really, for me as an economist, but not really, like, more of an entrepreneur than an economist, is how do you build a great business within that space? And the thing that I found to be lacking the most in cryptocurrency markets was actually trust between regulators, governments, government agencies, financial services, and the industry itself. And so that really what was missing is like building a layer of trust in the underlying technology. And we took a view that the way to do that was to build the most important data company in that. And so what we have done is say both governments and the commercial sector need to be able to understand how and why people are actually using cryptocurrencies. And so if you think about what cryptocurrencies actually are, these are open ledgers that are permanent, and they contain every transaction that have ever happened on that network. And what we have done is we've built sort of two sides of this market, where we've built an investigation product and platform that allows government agencies to be able to follow the money in this new financial context. And we've allowed sort of the private industry and commercial sector to comply with anti-money laundering obligations that they need to meet in order to mitigate the risk that their platforms are being abused by customers and used for terrorist financing or sanctions evasion or ransomware or stuff like that. And so we sit in the middle here, providing compliance software for the commercial sector and investigation software for the government. And we've grown to operate in over 70 countries around the world with over 750 customers. We're apparently for every employee we have one customer. That's recently happened to have that as equivalent. But we operate in 70 countries around the world, and have recently raised further funding to support the growth of the business, bringing the valuation of the business to 8.6 billion in May of this year. And really, the reason that we believe that we are sort of an integral piece of the industry is that we ultimately represent legitimacy. And legitimacy for me is about speaking the truth about what's happening on the blockchain and helping everyone in the industry make better decisions about anything that they need to about information that's contained within the blockchain. And that could be shining a light on the use of cryptocurrency by North Korea, or it could be explaining really the real world adoption of cryptocurrency in Africa. And we constantly are here really mapping out all of the economic activity that exists, and we maintain that as our proprietary data that we feed into the market for any use case. And so the thing that we've been maybe the most famous for in our history has been thinking about the national security concerns of the great powers competition. If you think about somewhere like North Korea or Russia and the recent conflict in the Ukraine, governments around the world are worried about sort of the possibility that North Korea could use cryptocurrency to evade sanctions, and that Russian oligarchs and the state are going to leverage cryptocurrency in some way that is against our interests. And so what we find is that we help equip the government agencies around the world that are tasked with understanding these financial networks. And yes, we've seen sort of the use of cryptocurrency by the Russian government to buy capabilities that helped hack into the DNC server, the Democratic National Congress server. We've seen North Korea steal money from cryptocurrency exchanges. We've seen ransomware conducted by Russian cyber threat actors. And so these are things that are actually able to be tracked on the blockchain. And actually the transparency of the blockchain has led to some of this money actually being recovered in some of these instances through the use of Chainalysis. And so really what we've seen over the last number of years is that it's possible to actually investigate this type of activity, and it's possible with the right authorities and right capabilities for law enforcement to actually take down sort of the largest darknet markets that were facilitating drug trafficking, or take down a critical piece of money laundering infrastructure that was in Russia, or charge North Korean hackers who stole money from an exchange, or disrupt some of the ransomware activity that we've seen sort of hit our schools and hospitals. And a lot of this is making sure that the law enforcement agencies that use Chainalysis have those capabilities to be able to go after that. But I want to make sure that although sort of the reputation of Chainalysis and the business of Chainalysis is built on making sure the government agencies have that type of capability at their fingertips, this is not the story about the vast majority of economic activity that's actually transacted in cryptocurrency. That cryptocurrencies actually are largely used for legitimate activity that's conducted between regulated financial institutions. That this total share of cryptocurrency activity as a share of all cryptocurrency activities is actually pretty low, and you're talking down less than 1% of the total activity is actually illicit activity. And when I mean that, we published this sort of 80-page crypto crime report, which looks at the way in which cryptocurrencies are used actually by illicit actors, like ransomware, like theft, like scams that we've seen. So it's still not an insignificant sum of money. This is still in the billions of dollars, but as a total percentage of the transaction volume, it's actually very small. Even though there have been sort of record years for stuff like ransomware. And so, we definitely see sort of this being a major threat that requires more investment from governments on information sharing and capacity building and investigations to map out all of the enablement infrastructure for this. And in fact, my colleague Jackie Coven was testifying in front of the Senate Intel Committee today on this topic, and proposing real policy options that are available to help mitigate this risk. And so I wanted to end with a case study that really points to what happens when you can actually trace this type of activity. And a case that I'm particularly proud of, the work that we do at Chainalysis. There was a disgusting website called Welcome to Video, which was the largest sort of unique distribution mechanism for videos of child sexual abuse material, and it was a membership type of website. there's a very good article that was the front cover of Wired magazine that actually walks through exactly how this case unfolded end to end from the investigation front, that was published by Andy Greenberg last month. But really, what this showed was, in this particular instance, I came across, one Bitcoin address that was associated to the website. And from that, found, 1 million associated Bitcoin addresses through the use of our technology. I found all of the different exchanges that were used as the on-ramps and off-ramps from this activity, and through, partnering with law enforcement, really managed to, dismantle this entire network, identifying the administrator of the website incredibly quickly, and identifying, over 337 users of the site that were ultimately arrested for their role in either watching or hosting or actually producing child abuse material. And actually, we rescued 23 children from harm's way through this investigation. And so, really, actually, in this instance, the transparency and permanence of the blockchain really actually allowed for law enforcement to crack down on this case and identify all of these different participants. Whereas, in these types of investigations, oftentimes, that's not possible to have such a big impact. And really, this is about the power of, understanding the nature of the technology, which allows for law enforcement to achieve these great results. And so, I think that the takeaway that I want to leave people with is that, this is a technology that can have a sizable impact on the economy with, its horizontal impact on lots of different industries. It is an asset class in its own right that, is attracting the attention of financial services, and armed with the right, capabilities, the government really does have, a new challenge on its hand, but has new tools to be able to actually, combat the emerging threats from this domain, which I'm sure a lot of people have questions about. So with that, I hope I haven't taken up too much time, Mark, and I hope that was a useful intro to what Chainalysis is and how I think about the space.
That's great. Thanks so much, Jonathan. And maybe you can stop sharing. And great to see you. And so let's see. So I guess one question that I have for you, one number that people often hear about with respect to the crypto world is the price of Bitcoin. So we hear a lot about that, and that is something that has evolved somewhat in recent months. Obviously, it's fluctuated a fair amount. And how do you think about what are the drivers of that? It's fallen about, I just looked before this meeting today, where it's down a little more than 50% from its peak. And there are obviously many factors that influence it, and it's hard to separate them all out. But what do you see as the sort of key factors that influence Bitcoin? And is it very different for others here, like Ethereum and so forth?
Yeah, it's a great question, Mark. So, I would look at it like this. I think people view it as really sort of a digital commodity that represents some form of like future where this is a, more massively traded, more massively adopted technology. And so, I think what you've seen is actually Bitcoin very much follow general tech stocks. And I think in an environment where, Bitcoin was clearly something that gained during the pandemic, and you've seen a pullback of virtually all the assets where, the future of the world seemed a lot closer than, what people originally thought at the beginning of the pandemic. And you saw a lot of the tech stocks valued at, very large multiples. And you see that all those losses all those gains have been eroded by losses today. And you see virtually all the tech stocks trade at, a fraction of their peak, and most of the gains sort of erased. And so, I think that, to some extent, it doesn't make, rational economic sense, given that Bitcoin doesn't have future cash flows associated to its fundamental value. But it does represent sort of how the market perceives an indicator of like what the future holds. And so I think you see it very much correlated with tech stocks, and it's clearly still a risk asset, and people are getting out of risk assets and into things that will store value more effectively.
Great, thanks so much. We've got some good questions coming in already, and I encourage others to feel free to send yours in. Another question that I have is, you put up these really interesting figure that showed the sort of disruptiveness of new technologies when they come in. They sort of are quickly adopted, and usually when that kind of rapid change happens, they're both winners and losers from that change. And so when you look out at the economy, I'm not sure whether the right way to think about this is geography, or is it industry, or is it what do you see? How do you see it sort of breaking out? Not everyone can win when you have a disruption that significant. So I'm curious who you think are the key losers and the winners, for that matter, from this.
Yeah, I think the interesting thing here is that, again, sort of you want to like split the world up multiple dimensions. There's clearly a massive skew demographically here that counters a lot of the sort of existing wealth creation mechanisms that exist in society. And so, here you've got sort of like unprecedented participation by young people in, what is actually being sort of a pretty large, all things considered, wealth creation event over the last decade. And so you've definitely seen a lot of younger people participate. And again, some of those people are actually like particularly underserved in more traditional financial markets. And so, I think that's probably the biggest sort of difference, if you will, comparing that to different asset classes. I think that the digital divide is still real in crypto. There's obviously a need for a level of sophistication for many people about that, although the barriers to entry for that are continuing to fall. And there's newer ways for people to actually get involved through, say, the creation of artwork or the creation of music, or some other thing that could be turned into a digital asset that actually allows for wider participation. But I think that's still something that the entire space still grapples with, is does the digital divide get worse, and does this exacerbate that? So those are the two quick observations. The geographic piece, we do a bunch of research where we normalize the world by sort of internet penetration, and look at sort of what countries then stand out on top of that when it comes to crypto. And there's some interesting findings around countries like Afghanistan and other sort of less developed economies that actually rise right to the top of that once you normalize for sort of internet penetration in that market. And that would indicate some form of use for crypto to subvert maybe authoritarian regimes, or get have an ability to store your own money if you don't trust the institutions that you are living under.
Great, thanks for that. So can we talk a little bit about the case of Russia, Ukraine, sort of specifically, and possible sanctions that are being lobbed against Russia, or maybe just the general concept of sanctions generally? But you touched on a little bit the notion that, for example, a specific country might be able to dodge sanctions. I think there's a concern right now with this sort of huge arsenal of sanctions being imposed simultaneously from many different directions, whether crypto is going to play an important role in responses by government, by companies, and so forth.
Yeah, look, I think crypto's role in the conflict is actually fairly interesting. Just more broadly, just taking a step back before we jump into sanctions, I think that there's potential for activity in the region to be picked up in advance of different forms of adoption, and cryptocurrency represents probably like one of the only sort of real-time infrastructures that everyone can look at to understand exactly what's going on within the region. And, you know, in the immediate aftermath of the invasion, you actually had the Ukrainian government raising funds from crypto donations that could get there a lot quicker than, you know, real world wire transactions. And so, you know, what I think there is important is that you actually have the ability to you know, get money anywhere in the world instantaneously, which actually, you know, helped the Ukrainians to some extent. You know, they raised about, you know, $100 million in aid and over those weeks, and bought supplies with them. The flip side of that, though, is, you know, the instantaneous nature, the bearer instrument nature, you know, gives rise to the possibility that, you know, cryptocurrency could be used to evade sanctions. And the question there is that, you know, for the government to do it on a systematic level to the, you know, extent of the size of the Russian economy, you're talking like that's a very large sum of money, and, you know, that's not something that's that realistic. And then if you think about it more on an oligarch level, you know, that's something that people have started to speculate a lot more about. I think there's a few things there that are interesting. One is, firstly, you know, money behaviors are incredibly sticky. I mean, the fact that the United States still use checks, like, really baffles me. Like, I just don't understand, like, how, like, I need to pay for certain things using a checkbook, and I don't even understand when I have to do that. So, but the point is that, like, you know, Russian oligarchs and people who have, you know, been under the threat of sanctions for a really long time have, you know, modes of moving money, modes of storing money that are sort of independent of cryptocurrency. And actually, when you think about cryptocurrency as truly a bearer instrument, it becomes a lot harder to think through how you architect the governance to manage such a large sum of money. So I'll give you some perspective. Like, there's not that many institutions around the world that have constructed a safe system to hold, say, $1 billion worth of crypto. Sorry. You know, that has just not really been the case. If you look at internationally, how people have, how many exchanges have managed to do that successfully. Sorry. Sorry about that.
Bless you.
I don't think I have COVID, but
Okay, you're far enough away.
yeah, but no one could catch it over Zoom. So I think that, you know, that's a component as well, is that, you know, there's not that many organizations that could ultimately do that. And then, you know, the final thing is that the permanence and transparency of Bitcoin does mean that, you know, even if they could get away with it today, you know, could they forever evade detection and then therefore, like, sort of actions apart from that? And so, you know, I think that the transparency of it, and the difficulty in sort of holding sort of that magnitude of funds, makes it kind of difficult to have systematic levels of evasion. I think that, you know, seeing sort of everyday Russian citizens hold some of their holdings in Bitcoin or Ethereum or even a stable coin, you know, that seems to be pretty reasonable to think that they would do that, given their distrust for you know, Putin's institutions. And so you might see that dynamic play out a little bit more over time.
Great, thanks for that. And I very much hope you don't have COVID, by the way. Having myself had it a couple months ago, it was no fun. So I really hope you don't have it. So one thing that we talk a lot about at SIEPR every year, maybe every quarter, is taxes. And I'm curious to hear your take on, you know, crypto is, like you said, in many respects, an asset that people will buy and then subsequently sell. I'm curious to hear just your thoughts on the taxation of it is working. Is it working well? An example of an issue that we'll engage on sometimes at SIEPR is the capital gains tax rate at the right level, right? But if they were sold, they would be subject to capital gains taxes. If they were held long enough, it would be a lower rate than if they were held for a shorter period of time. But can you just talk a little bit about crypto and taxes?
Yeah, for sure. I mean, look, and again, like just focusing on the US for now, and there's a global sort of tax regime that the OECD has been putting out. But in the US, I mean, I think that most of the crypto assets are considered property, and they are subject to capital gains taxes. I think that's fairly reasonable given their use today. But the thing that strikes me as sort of particularly strange is that there's not a de minimis exemption. So that any cryptocurrency transaction technically has sort of capital gains implications. So if I buy Bitcoin 1 minute and then buy a cup of coffee the next minute, I actually technically need to like calculate the capital gains on even sort of coffee amount of Bitcoin. And so that strikes me as completely ridiculous and something that the IRS could fix very quickly. And sort of the thornier issues, I think, are in the like for like trades. So if you've got one crypto asset and you swap it for another crypto asset, have you actually realized the capital gain or not? And there's a few sort of other sort of peculiar things of like what happens if someone sort of quote unquote airdrops you a token to your Ethereum address. Do you now pay sort of income tax on that token that you didn't even ask for, that sort of arrived in your wallet? And so the interesting thing here is that there has been some guidance from IRS, and largely sensible guidance around how they're going to treat certain things, and they've been cautiously waiting on some of the more sort of sophisticated and sort of difficult scenarios. But for the most part, people do understand that they have to report taxes, and the exchanges themselves, the venues, are going to start supplying 1099-Bs similar to your brokerage account on gains and losses in your crypto account. And is there under reporting today? Like, sure there is, but that will start to close the more sort of reporting requirements are put on intermediaries that the government is getting around to. So I think that overall, a situation where you've got permanent records again and transparency means that it's not a great place to hide if you're going to hide taxable gains.
Great. Okay, thanks for that. And just I have one more question, then I'm going to go to audience questions, and we've got a bunch of really good audience questions. And mine has to do with my final one has to do with energy use. Obviously, like Bitcoin mining, for example, is using a lot of energy. I'm curious to hear your thoughts on that. Are there ways that we can mitigate it? And is that something that's likely to get worse over time? Obviously, there's just a lot of concerns about energy and climate change and all that.
Yeah, I think the interesting part about this is like, in this country, a lot of the Bitcoin mining is actually done in renewable energy sources. And there's actually an interesting phenomenon with Bitcoin, which is that the Bitcoin mining can be situated right next to sort of excess power being generated in different parts of the world. And you could actually generate power in the middle of the Saharan desert, which doesn't have any real world utility because you can't transport it. But actually, if you mine Bitcoin there locally, you can convert that energy into Bitcoin and actually sometimes subsidize sort of the use of renewable energy sources. So there is some of that dynamic. That being said, like, it's called a spade. Like, there is a lot of energy usage, particularly in sort of other countries around the world. And I think when you look at like the maturation of the asset class, I think you have the same type of reporting requirements and the need for analytics to help inform investors and financial institutions about what their carbon exposure is and the similar sorts of ESG filings that you would need to make at the SEC. So we're starting to see that in having more sophisticated financial institutions enter into the space. And so and it's very possible to actually run the analytics on how the cryptocurrency is being generated today, and where exactly that ends up. So I think that overall, I would say it's not like a showstopper for Bitcoin. I think that it's definitely going to present a challenge for Bitcoin, but it's going to mean that there needs to be reporting requirements and an infrastructure built to do that. Something that I was in environmental economics before I got into crypto, and so I think a lot about how that may end up working as an incentive program. But then also, I would say cryptocurrencies more broadly actually have other sort of consensus mechanisms that are less energy intensive, and there's lots of uses of that outside of just Bitcoin.
Great, thanks for that. I'm going to go to some audience questions, and please feel free to send them in. But I certainly have plenty here to draw from. So the 2021 Global Crypto Adoption Index that Chainalysis puts out has identified a 10-fold increase in grassroots cryptocurrency adoption this year. So a big increase in the number of people using crypto, especially in regions like Vietnam, India, and Pakistan. How is this affected by volatility and price fluctuations in cryptocurrencies? It seems like grassroots adoption may be good for the ecosystem, but maybe it's drowned out by the interests of rich speculators. So thoughts on that?
Yeah, it's an interesting phenomenon. I mean, like the way I think about the market cycle is maybe a little bit different to the sort of effects, meaning one drowns out the other. I think that we've seen sort of volatility in the price and market cycles being fairly short in crypto land, if you will. And really what that represents is that people get very excited about applications that are being built and the potential for the technology, and it attracts a lot of people, both grassroots and sort of rich speculators, as the question points out. You get a lot of price appreciation, and then you see sort of market correction. And in the market correction, what tends to happen is actually a lot of things get built. Chainalysis was built actually during one of these sort of downturns in the crypto market. Ethereum was built in one of those downturns, and so then ultimately that then fuels the next wave of sort of interest and adoption, which then drives sort of market cycle up, and people get really optimistic about the future of this industry, and that continues to drive upwards. And so that's kind of how I see sort of the market trends over time. And volatile prices definitely do attract rich speculators as well.
Okay, thanks for that. Okay, another question from our audience: what are the one or two most impressive use cases of the blockchain in corporate environments that give you the greatest hope in the future of the blockchain as potentially the next internet?
So I think that it's a great question. I think that it's less for me about the use in corporates that gives me the most excitement. Like the way I think about the technology really more broadly is that ultimately, and I forget who said this. I should really know who said this, but it's probably misattributed even if you look it up on Google. But there is ultimately only bundling and unbundling. If you think about sort of a lot of what the internet has done is it creates sort of the possibility to break down a particular enterprise into residual components, and publishers being decentralized or consumers being aggregated, and ultimately it's like the process of just unbundling different services, carving them out, and then ultimately they get rebundled together because they cause greater economic efficiency. And the way I think about the cryptocurrency technology is that ultimately it's a great use of having a technological force that creates some form of unbundling, only for then enterprises and corporations to then rebundle those services. And so, I'll give you two sort of good examples that I think are interesting. Is that there's creating sort of hardware networks of mesh networks and actually electric vehicles that are done through the use of cryptocurrency. There's a project called Helium, which has enabled the takeoff of the largest wireless mesh network in the United States, where people are incentivized to offer bandwidth in return for cryptocurrency. And that creates sort of a new market, and obviously then there can be bundling that takes place on top of that, but effectively you create sort of this decentralized underlying market. But then again, I think that there's things like OpenSea, which is a NFT marketplace where I don't really understand Bored Apes or CryptoPunks or some of these art projects, but there's enormous interest in digital collectibles that are now only possible for the first time. And so I think seeing sort of the creation of these new markets and them get to billions of dollars in transaction volume, or millions of people sort of adopting these technologies, that gives me encouragement that actually we are onto something that is truly disruptive here.
Terrific. Thanks for that. Now, another question comes in about laundered cryptocurrency. So if someone identifies laundered cryptocurrency, especially after processing by a mixer or a service like CoinJoin, there's some disagreement over how the outflows from that transaction should be handled. If stolen crypto passes through a tumbler as an inflow, now I don't know the jargon here as well as you do, are all the outflows now considered stolen goods, or only some of them? What do you think of various proposals for how to handle these quote unquote tainted coins as they flow through multiple wallets?
This is the perfect question to do over Zoom with no whiteboard facility. So let me give you the quick answer. The way in which this works is actually pretty technical and in the weeds of how each individual blockchain actually handles. So it actually sort of relates to how much information is actually contained within the blockchain to answer this question really well. The short answer is that most businesses make risk-based decisions, and so when they look at the last counterparty and the last counterparty that they can identify that was used in sort of the provenance of some crypto that they receive, if they see it as a mixing service, they may just judge that as the risk indicator to make a decision about how to treat those funds. When it comes to then law enforcement and actually building cases and potentially being able to trace through mixing services, then you have sort of legal, actual legal levels of evidence that need to be produced in order to then affect something. And so there it is much more about sort of knowing that the same funds are in fact related to that mixing service, or the perpetrator is still in control of those funds. And so I would say it two ways. One is I don't think there's a generic answer that exists just on the blockchain. Most exchanges have different risk tolerances for mixing technologies and mixing services, and law enforcement and actually exchanges can sometimes investigate and then provide more information so that it can be followed up in a law enforcement case where again sort of the balance of evidence of that will be tested actually potentially in a court to determine sort of who is the rightful owner of that crypto. That's a great question.
Yeah, excellent. Thanks. Okay, so I have a couple of questions. I'm going to fold them into one, and they may be the same thing. I have these questions about how will these things either taproot or Mimblewimble affect your ability to trace illicit transactions on the blockchain? So I have no idea. I've never heard those two, Taproot or Mimblewimble, before, but maybe you know what these mean.
Yeah, so this is very similar to the mixing question, which is, to some extent, there can be technologies that obfuscate, some part of the data structure in the blockchain that makes it harder to trace transactions. And when I think about this, I think about there are definitely ways in which people can attempt to obfuscate transactions. And can you obfuscate one transaction very well? You can, but can you systematically do it? Can you do it over 2 years? Can you do it with the idea that these technologies are actually permanent in nature, and although that maybe something can't be investigated or solved today, maybe it can be done over time. And so I'm not super worried about these technologies as being sort of completely ubiquitous in the whole cryptocurrency market going dark, because if you look at sort of these technologies have been in existence a long time, and we've probably had the adoption of cryptocurrency by the most privacy conscious people on the planet, and you notice that they don't actually adopt these types of technologies. And it's often the case that the behavioral way that people actually use those technologies actually doesn't give them the anonymity that the technology itself proposes to give. So yeah, I don't, it definitely makes life tricky, but I don't think about it as sort of systemically risky to our business or to cases being solved.
Excellent, thanks. And then final question concerns, so last week we had an event at SIEPR where one of the things we talked about were public pensions, and the sort of asset holdings of public pensions in the US, like CalPERS and CalSTRS, and we've got sort of university endowments sort of thing. And I guess one question that I have from the audience is whether you see much use of crypto yet in these sorts of, sort of traditional, very traditional, big sources of investment. And maybe it would just be anecdotal. I heard of one very elite university potentially putting some of their endowment in Bitcoin, but maybe it was just here. So I'm not sure.
Yeah, there have been, like, to your point, Mark, there's a little bit of anecdotal evidence on this. I think that the point here is about sort of optimal portfolio construction, and it relates back to the point really earlier about sort of what are the winners, what are the losers in this scenario. I do think that we're getting to the point where cryptocurrencies are sort of here to stay and therefore represent sort of a very significant economic opportunity, and one where it may make sense for 0.5% of the portfolio to be able to be allocated towards it. And I know that sounds sort of crazy, but the same was true for commodities, right? So endowments and pension funds have been wrestling with whether they should hold a basket of commodities as part of the long-term investment strategy. And to the extent that there is sort of some of that going on in this digital world, maybe it does make sense for pension funds and endowments to hold those assets. A lot of them have been holding sort of venture capital funds and other things that try and sort of make sure that their returns are correlated somewhat with the future. And so I don't see it as being that crazy to think that a small allocation in one of these funds is a bad idea.
Terrific. Well, Jonathan, I just want to say thank you so much for making time to be with us here today. I'm very happy to report that during this session, I received an email that the winning design for the SIEPR t-shirt had been selected. And so we'll be making those soon and sending one your way. So look forward to getting a SIEPR t-shirt as a very small token of our very large gratitude for your being here today. And I think that for all of you who are watching at home, today, this week is finals week at Stanford, so things are winding down. We are already at work for a great lineup of events for next year, and we look forward to connecting with all of you then. I don't know, Jonathan, is there any final thoughts you'd like to share? I guess we're at 6, but any final thoughts you'd like to share?
Yeah, I mean, look, I think I think we're in for sort of a very large sort of bet on the future of the internet and commerce. And look, we at Chainalysis are here sort of building that out. We're headquartered in New York, yeah, it's a pleasure to engage with academia around the world, as well as the supporters. And if there's something that you want clarified, or you're interested in working with us, I'm Jonathan at Chainalysis.com. I managed to lock in that email this time around, rather than get Jonathan rather than get Jonathan.Levin at economics.ac.uk. That's been sort of my journey, and my Twitter's open, my email's open, and happy to
Wonderful.
engage. Happy to
Great.
engage.
So yeah, for those of you who are watching, please feel free to reach out to Jonathan, or if there's anything we at SIEPR can assist on, feel free to reach out to us too. But thanks to all of you for engaging with us today, and hope that you're looking forward to the summer months ahead, and you will be hearing from us very soon about what we've got planned for the coming year. But thank you so much again, Jonathan, and hopefully we'll get, if you're in the Bay Area anytime soon, we'll get in a bike ride. I don't know if I can go 350 miles as you recently did, but maybe I can take you around for a little ride around the Stanford campus. So thanks everyone, and hope to see you all soon.